Are you interested in making profits in the cryptocurrency market? If so, then you need to learn about cryptocurrency trading strategies. In this video, I'm going to share some of the most popular cryptocurrency trading strategies with you. I will also share some tips and insights that I have learned from my own experience. By the end of this video, you will have a good understanding of the basics of cryptocurrency trading strategies. You will also be able to identify some of the most common mistakes that traders make. So if you are interested in learning more about cryptocurrency trading, then let's get started. Cryptocurrency trading strategies. These strategies involve various approaches and techniques to make informed decisions when buying or selling digital assets. Here are some popular cryptocurrency trading strategies. Number 1. Day trading. Day trading involves executing multiple trades within a single day, taking advantage of short-term price fluctuations. Day traders closely monitor price charts and use technical analysis indicators to identify potential entry and exit points for their trades. They aim to capitalize on small price movements and often use leverage to amplify potential gains. However, day trading requires a lot of time, attention, and discipline, as it can be highly stressful and risky. Number 2. Swing trading. Swing trading focuses on capturing price swings or swings in the market over a few days to weeks. Swing traders use technical analysis to identify trends and support or resistance levels, aiming to buy at the bottom of a price swing and sell near the top. This strategy allows for more flexibility compared to day trading and is suitable for those who can't commit to constant monitoring of the market. Number 3. Trend trading. Trend trading involves identifying and following the prevailing trend in the market. Traders look for higher highs and higher lows in an uptrend or lower highs and lower lows in a downtrend. Trend traders enter positions when they believe the trend is strong and exit when signs of a trend reversal appear. This strategy aims to ride the momentum of a trend for as long as possible. Number 4. Breakout trading. Breakout trading focuses on identifying key price levels, such as support and resistance, and entering trades when the price breaks out of these levels. Traders look for significant price movements after a period of consolidation. Breakout trading can be profitable if executed correctly, but false breakouts can lead to losses. Traders often use stop-loss orders to manage risk in breakout trades. Number 5. Scalping. Scalping is a high-frequency trading strategy where traders execute multiple small trades throughout the day, aiming to profit from tiny price movements. Scalpers hold positions for only a few seconds to minutes and rely heavily on technical analysis indicators and short-term trends. Scalping requires quick decision-making, low trading fees, and advanced trading platforms. Number 6. Arbitrage trading. Arbitrage trading involves exploiting price differences for the same cryptocurrency on different exchanges or across various trading pairs. Traders buy at a lower price on one exchange and sell at a higher price on another, making a profit from the price discrepancy. Arbitrage opportunities are often short-lived and require fast execution and efficient funds transfer between exchanges. Essential tips and insights. Here are some essential tips and insights on cryptocurrency trading, covering technical analysis, chart patterns, and risk management. Number 1. Educate yourself. Before diving into cryptocurrency trading, educate yourself about the market, blockchain technology, and the specific cryptocurrencies you are interested in. Stay updated with the latest news and trends to make informed decisions. Number 2. Understand technical analysis. Technical analysis involves studying historical price charts and using indicators to predict future price movements. Learn to read charts, recognize patterns, and use tools like moving averages, relative strength index, and Bollinger Bands to inform your trading decisions. Number 3. Identify chart patterns. Chart patterns can provide valuable insights into market sentiment. Learn to recognize patterns like triangles, head and shoulders, double tops, and double bottoms. These patterns can signal potential trend reversals or continuations. Number 4. Practice risk management. Managing risk is crucial in cryptocurrency trading. Never invest more than you can afford to lose, and use stop-loss orders to limit potential losses. Diversify your portfolio to spread risk across different assets. Number 5. Start small and grow. If you are new to trading, start with a small amount of capital and gradually increase as you gain experience and confidence. This approach allows you to learn from your mistakes without risking significant funds. Number 6. Have a trading plan. Develop a clear trading plan that outlines your goals, risk tolerance, and strategy. Stick to your plan and avoid making impulsive decisions based on emotions or short-term market fluctuations. Number 7. Follow market trends. Stay updated with the overall market trends and sentiment. Pay attention to social media, news, and market influencers as they can impact short-term price movements. Number 8. Use demo accounts. Before trading with real money, practice using demo accounts provided by some exchanges. This allows you to test your strategies and familiarize yourself with the trading platform. Number 9. Be prepared for volatility. Cryptocurrency markets are highly volatile. Be prepared for price swings and avoid making impulsive decisions during periods of extreme volatility. Number 10. Stay disciplined. Stick to your trading plan and be disciplined in your approach. Avoid chasing after quick profits and remain patient in the face of market fluctuations. Number 11. Never stop learning. The cryptocurrency market is constantly evolving. Keep learning and adapting your trading strategies based on new information and experiences. Remember that cryptocurrency trading involves risks, and there are no guarantees of profits. Only trade with money you can afford to lose, and consider seeking advice from experienced traders or financial advisors. Stay cautious, stay informed, and always conduct your due diligence before making any trading decisions. Risk management. Cryptocurrency trading risk management is a crucial aspect of successful trading. By implementing effective risk management strategies, traders can minimize potential losses and protect their capital. Here are some essential risk management practices for cryptocurrency trading. Position sizing. Determine the appropriate size of each trade based on your overall trading capital and risk tolerance. Avoid putting all your funds into a single trade and limit your exposure to a certain percentage of your total trading capital per trade. Set stop-loss orders. Always use stop-loss orders for each trade to automatically exit a position if the price moves against you. Set stop-loss levels based on technical analysis or the maximum amount you are willing to risk on the trade. Use take-profit targets. Set take-profit targets to secure profits when the price reaches your desired level. Taking profits along the way can help you lock in gains and avoid potential market reversals. Risk-reward ratio. Assess the risk-reward ratio of each trade before entering. Aim for trades with a favorable risk-reward ratio where the potential reward outweighs the potential risk. Diversification. Diversify your cryptocurrency holdings across different assets to spread risk. Avoid concentrating your investments in a single cryptocurrency or sector. Avoid overtrading. Resist the temptation to overtrade, especially during periods of high market volatility. Overtrading can lead to impulsive decisions and increased exposure to risk. Don't chase losses. If you experience a loss on a trade, avoid trying to immediately recover it by taking more significant risks. Stick to your trading plan and remain patient. Stay informed. Keep yourself updated with the latest news, market trends, and developments in the cryptocurrency space. Being well-informed can help you make better trading decisions. Use trading tools. Utilize risk management tools provided by trading platforms, such as trailing stop-loss orders, to lock in profits and protect against sudden market downturns. Avoid margin trading. Leverage. While margin trading can amplify potential profits, it also significantly increases the risk of losses. Avoid using excessive leverage, especially if you are a beginner. Stay emotionally detached. Emotions can cloud judgment and lead to irrational decisions. Maintain a disciplined and rational approach to trading, even in times of market uncertainty. Practice risk assessment. Before entering a trade, assess the potential risks and potential rewards. Consider factors like market volatility, news events, and overall market sentiment. Remember that risk is inherent in cryptocurrency trading, and there are no foolproof strategies to eliminate all risks. The goal of risk management is to minimize losses and protect your trading capital to ensure long-term sustainability in the cryptocurrency market. Always trade with money you can afford to lose, and consider seeking advice from experienced traders or financial professionals if needed. That's all for this video. I hope you found it helpful. If you did, please give it a thumbs up and share it with your friends. And if you want to learn more about how to trade cryptocurrency, be sure to subscribe to my channel. I will be releasing new videos on cryptocurrency trading.